Okay, a quick word before we head in this week. Look at this word here. Who doesn't like that word, right? Free financial modeling preview. This is until October 20th. Here is the link for it. You need the link to get to it. It's not listed on the site. It's this link. It's the first link in the description box. And in there I've placed three videos in the series. The series is much longer, but I placed 3 videos. We're using Costco, so I put a Costco introduction video. I put a financial modeling introduction video, which is a discussion about what we're trying to get done. And using Excel, we're going to set up the Excel spreadsheet and enter historical data, and I start from a blank spreadsheet. So if you're interested or curious to see how financial modeling is done, and how you would set up your Excel spreadsheet for it. This is a free preview. You just have to follow this link. It is free until October 20th, and then it disappears. For the sector studies, cybersecurity progressing nicely. I got to tell you, as a lot of terminology. If you don't know the terminology when you're reading these 10Ks, you're thinking, what the hell does any of this mean? There's so much terminology. I'm going to try to limit it, but there are certain things you have to know, certain definitions you're going to come across a lot. And to be able to tell one company from another, you do have to have an understanding of the architecture of what it looks like to say, when some company says, we do this, it's like, well, what is that? Where do you sit? So there's about another 2 to 3 weeks to go. I am definitely going to be using Palo Alto because they have a nice broad product range that covers everything. It covers a lot of stuff that we need to know. The other one, I'm not sure yet. I don't know about using CrowdStrike, even though they're kind of interesting, just because of the legal problems they have. I don't want to, give anybody any ideas that perhaps I'm using them because they represent a really good company. I'm using Palo Alto because they're broad. Cisco is interesting. IBM has some stuff, but IBM has a bunch of other stuff as well. I'd like to find a really nice pure play that maybe focuses on one aspect of it. CrowdStrike seems to be the more obvious one to use, but I'm just going to put a question mark there. I'm not quite sure yet, but definitely this is happening. About 2 to 3 weeks, and definitely Palo Alto. That's as much as I have for you now. Anyways, let's head in and check out the preview. Let's begin with the economic data from last week. Sunday out of China. Well, Sunday our time. Sunday out of China, we have some PMI, manufacturing and services. This is for September, and the data collection period was prior to the announcement of all the stimulus. And there is sort of a mixed reaction on the stimulus that, on the one hand, it will probably result in more upside to Chinese stocks. But on the other hand, it may not actually do much in the real economy. So I think it might be worth paying attention to their economic data to see if there's going to be a disjointed reaction between equity prices and what's going on in the economy. However, the Chinese government has said they will do rounds upon rounds of this stuff. So as far as Chinese equities go, if you have a look at a 10-year chart, even though there's been a really big significant rally, it is nothing compared to the levels it used to be. But it was at those levels when there was a lot going on and most of the world was zero interest rates, right? So it is that, just to be aware, that's the big question right now. Manufacturing 49.3 down from 50.4, and services 50.3 down from 51.6, both of them negative, but again, pre-stimulus. Next, I include some inflation data from Europe. We have some from Italy, Germany, and Germany breaks it down into a whole bunch of regions, but I'm just going to give it to you at the country level and for the European area itself. Let's start with Italy. Year over year, inflation 0.7. Month over month, you're in deflation for that month. And this is all for September. Germany, year over year, 1.6. Month over month, nothing going on. Month before was in deflation. For the European area as a whole, 1.8 on the inflation rate year over year. You're below 2%. Previous reading was 2.2. Core, still a little troubling, 2.7. Last reading was 2.8. Month over month in deflation. These are just year over year numbers, month over month. Combine that with the PMIs that we saw last week, which were, all of them came in lower than both the previous month and the consensus. I can pretty much say with confidence here that you can pencil in a rate cut at the next meeting. How much of a rate cut? I don't know. I think they're probably in the better position to use 50 basis points. The U.S. was not, which is why I didn't think they'd go 50, but they went 50. And with this week's jobs report, it's looking like maybe you shouldn't have done 50, right? We'll get there. JOLTS openings increased to 8 million from 7.7 million. But there is some talk about that some of the, not even some, but quite a few of those jobs may be what are called ghost jobs. These are companies that don't really have an opening, but are posting a bunch of openings to give the impression that they have growth, and that there are actually no openings for those jobs. And this is very common in a bunch of tech companies that want to give the impression that they're growing, that they're hiring in a whole bunch of divisions, but they're not actually hiring. So I don't know what to make of that. 8.04 million seems to be going in the wrong direction for quits. Quits dropped lower. That if fewer employees are quitting, there'd be fewer need from companies to post the job again, saying, oh, well, we thought it was filled, let's post it again, right? If you had quits increasing, I can see that month over month, that would suggest, well, yeah, you should have job postings increasing because people have quit. But quits are reducing and job postings are increasing. Hires were 5.3 million, separations were 5 million, quits were 3 million, so you can see that involuntary separations, well, not just involuntary separations, but involuntary separations and retirements would have made up the other 2 million. Going in Wednesday into the U.S., ISM manufacturing. Nothing much to see here, 47.2, previous 47.2, consensus 47.5, flat. Well, I shouldn't say flat. It's still a contraction from the previous month, but at the same rate. Manufacturing employment, 46 down to 43.9. But new orders, 44.6 up to 46.1. That's interesting. And prices, 54 down to 48.3. So that is helpful in justifying the Fed 50 basis points. You can have a strong economy, but if inflation just is not there, which is sort of my base case, that once we, as we continue to move forward, we will get to a sub 1% inflationary environment. Even with growth, I think you'll still get there, which means you can lower rates. But that is helpful here. In the middle of all of this is construction spending, month over month, negative. It was negative 0.5 the previous month, revised from a negative 0.3, so it was a step down, and then month over month it was a small step down again. Put South Korea up here because that's a central bank that's going to be having a rate decision this week. Look at their inflation rate, no problem here. 1.6% is below the 2% from the previous month, and below a central bank. Again, you can argue that it's arbitrary, but an arbitrary 2% level. And month over month, 0.1 down from 0.4. Mexico, I got a lot to say about Mexico versus the yen. I think that carry trade is relatively safe for a while, and the currency really showed it on Friday with a strong US dollar. You had an even stronger peso and a weaker yen. That is the pattern we've seen for a while. Gross fixed investment, month over month, up 1.8%, and year over year, up 6.4%. Fixed investment increases the productivity of an economy. ADP employment, boy, were they wrong, right? 143, and they revised the previous month to make them less wrong. I anticipate when we get the October ADP, we'll see that this is revised significantly upwards to make them less wrong. But the always wrong ADP came in at 143. A good 100,000 off, right? Crude oil, I don't really know that inventories are driving prices at this point, or that they will drive it at this point, but you had a build in crude oil stocks and you had a build in gasoline stocks. Prices are going up. Inventory is not what is driving price. In the short term, I think you have to be geopolitically bullish, or at least geopolitically not bearish. I think it would be dangerous to short oil at this point, thinking that, oh, well, nothing will happen, it'll all be over, and we got to get back to what's going on behind the scenes, is that demand is not going to build as fast as supply is going to build going forward. I think long-term supply-demand, for supply-demand characteristics, you have to be bearish on the price of oil. I do think you'll see $60 oil. Let's fast forward 12 months, 60, maybe even $50 oil, just based on what other countries are suggesting they want to do. I have a whole segment on Israel's potential response to Iran. One of the responses is to take out either an oil refinery and just cripple Iran, or take out an oil export facility where 90% of the oil is exported from, and take out Iran in a more significant way by cutting off their source of funding. But that would hurt China, because most of that stuff goes to China. Surprise, surprise, that Iran supplies China and that China is willing to do that, right? Surprise, surprise. Certainly not going to Great Britain. So this is the big driver here. You have October 7th coming up tomorrow, which is the 1-year anniversary. You have Israel and the IDF vowing a significant response to Iran's missile barrage, and they have 3 choices on what they want to do. I'll stop there because I got a whole screen on that. Okay, Thursday. I'm not going to follow Turkey. I just thought you might want to see what hyperinflation looks like. Look at their inflation rate. Year over year for September came in at 49.38%. The U.S. Federal Reserve was, concerned about 3.3%. Imagine what interest rates would be at 49%. Well, we know what interest rates are in Turkey, but 49.3. Month over month, up 3%. PPI, 33% year over year, month over month, 1.37. Ouch. That's inflation. Back to the U.S. initial jobless claims, 225. This is not bad considering the hurricane that took out a path from Louisiana, Florida, all the way through the Atlantic coast. Continuing jobless claims, relatively unchanged. ISM, can't argue with this one. This was the biggest number for quite some time. Services, 51.5 up to 54.9. That is a significant expansion. Business activity, 53.3 up to 59.9. Employment, 50.2 down to 48.1. You see employment and manufacturing PMI down and services down, yet the jobs number, right? ISM services, new orders, look at this, 53 to 59.4. incredible. This is not good. Prices paid 57.3 to 59.4, being that services makes up closer to 70, I think it's 78% of the economy, manufacturing 22 and shrinking, services getting bigger. And I think this has to do with the aging population and the size of the population, usually beyond the age of 45. Your purchases tend to peak at around 45, and beyond the age of 45, your purchases tend to decrease. You tend to keep your car longer, you don't change your furniture as much, you're pretty much set up in your house, you've done all the remodeling that you want to do. And then when you get to 65 plus, it's very little purchasing on goods. You're not buying new furniture, new vehicles, you're not even buying very many new clothes, to be honest with you. You're spending a lot on services at that point. I have a screen coming up which looks at just the sheer size in the U.S. of the population that is 65 to I think 65 and older, or 65 to 74. We'll see it when we get there, which does explain quite a bit of the increase we're seeing in money market funds. So I think that the aging population has something to do with just the strength in services, the strength in the economy, even though manufacturing is telling a different story. U.S. factory orders, here again, right? Negative 0.2. The 4.9 was revised down from 5%. Take out transportation, negative 0.1. The 0.3 from last month was revised down from 0.4. Okay, in Friday, we had from Mexico the unemployment rate 3%, previous 2.9%, lower unemployment rate than the U.S. Auto exports, this is good news here. Auto exports year over year up 4.8%. The previous reading was 1.7%, and auto production year over year up 11.7% from 8.3%. Good economic data coming out of Mexico, and a shift in the rhetoric coming out of Japan, I think, supports the peso. We have a 19 handle on the peso, I think 19.3 to 19.4 right now. I wouldn't be surprised to see an 18 handle on that sometime during the course of the week. And then the big one that really changed the conversation, ISM Services did a lot to say, hey, the economy is really strong here. Maybe they won't go 50 next time. This really does it. Now the choice, we'll see the choices with FedWatch. There is a zero in there. There is some probability that they won't do anything, that there'll be no rate cut. I seem to think they'll probably stay on course for 25 because I do believe the inflation part is solved. You don't need as restrictive a set of rates, but we do have CPI coming up this week. We'll see what that looks like. Non-farm payrolls hitting it out of the park, 254,000. Break it down, services, 202,000 of the 254. Manufacturing lost jobs, you can see down here, -7. Services carrying the economy. Education and health up 81. Leisure and hospitality up 78. Between the two of those, that's 160. That's 80% of all the services jobs come from pure services. You can imagine, well, if you were retired, what would you most likely be doing? Well, a lot of healthcare, a lot of leisure, a lot of hospitality. Retail up 15.6. Up, you're coming into the holiday season coming up. Retail is up. Private of the 254, private was 223. That's what you want to see, that private makes up the vast majority, 80, 90%, 95% of all jobs. Well, there we go, 90%. The household survey showed 420. So the establishment survey and the household survey are in agreement that, okay, well, maybe we don't trust the numbers, but the direction is right. Labor force was only up 150. So if the labor force increases 150 and you're creating 254,000 jobs, the unemployment rate has to go down. Mathematically, it has no choice. So let's look at our unemployment rate, 4.2 down to 4.1. It had no choice. right? It's straight math. Average hourly earnings month over month, 0.4. It was actually 0.369. The month before, 0.5 was actually 0.456. So it's not quite 0.1%. It's 0.87, but you get it. It's not 0.5 or 0.4. I really wish they'd go to 2 decimal places. It just makes sense. There's missing information. I've been saying this for quite some time. I think it's, why not? Why not just take it to the 2nd decimal place? Show of hands. Who agrees with me here? Average hourly earnings, 4%, 3.97. Okay, maybe you can get away with no decimal places there, right? Participation rate, unchanged. Average weekly earnings, because you did have a drop down in hours, right? 34.2 from 34.3, and you had an increase in the hourly earnings, but the weekly earnings is a combination of how many hours you work and what you get paid. Call that flat, 0.076%. So even though we've got an increase in weekly earnings, in hourly earnings, existing workers aren't going home with more money, so the square isn't really increasing. It's more like a rectangle, if you think about it in terms of number of workers and what they earn. The number of workers increases, but what they earn hasn't, so you've gone from a square to a rectangle because there's only this part. If you have this going on at the same time, well, then you have, this going on from more earnings, this going on from more workers, plus an interaction effect. There is no interaction effect. There's just more workers making what everyone else is making. Still supporting aggregate demand, though, right? Non-farm payroll, we already talked about 223. And the U6 unemployment rate, 7.7. So the gap between U3 and U6, 4.1 to 7.7 is 3.6%. The month before was 3.7%. Again, going in the right direction. Can't argue with that. Full-time, up 414. Part-time, down 95. Can't find any fault there. Let's look at the diffusion indexes. For total, 57.6 versus 51.8. So that is the total of all industries. The number means that more are hiring than not. 57.6 up from 51.8. Manufacturing, 42.4 versus 38.9. Yeah, less hiring in manufacturing, but not at the same rate, at a bit of a slower rate. Okay. As far as the distribution of jobs, we're seeing a return to education. Less than high school, negative 155. High school, negative 587. Less than a BA. Some college, but not all the way through, up 328. A BA plus, up 309. We are turning more into an education-based services sector. Go ahead and say that. 16 to 19 up 231, 20 to 24 up 158, 25 to 54 up 48, and the 55 plus, that is surprising, up 111. Can't find any fault there. Hard to find fault with this earnings report, almost as if it was tailor-made to say, well, let's make sure that everything is good and that the talking heads when they dissect this can't say, oh, but if you look under the surface, there's nothing under the surface. It's all good. And add to that, on Friday, you got the news that the port strike is over. They'll get some of what they get to the point where they negotiated. They're going to keep negotiating, and they're going to postpone any potential strike to January of 2025. Let's get past the Christmas season. Let's not mess up the economy for the upcoming election. You don't want to hurt the Democrats. And if the union is supporting the Democrat, they probably don't want to see Trump in there. They want to see the Democrats. So it made sense to say, hey, look, we've come a long way. We've gotten our money. We've got Christmas coming off. Nobody wants to walk a picket line in front of Christmas. Nobody wants that. Hey, guys, what do you think? We postpone this to January? I'm sure that was an easy sell. I think they got 62% of their 77% wage increase, but nothing firm on the automation. Last week I made a joke about somebody sitting in a booth pressing a button to raise a gate and lower a gate. Well, during the week you found out that that's actually serious. It's not just a joke. They do not want Any kind of automation, even for a gate. There must be somebody there to open the window, reach out, grab the ticket, look at the ticket, punch the ticket, press the button, raise the gate. How dare you automate that? They don't even want that. So, I don't know. Okay, over the past week, mostly Friday, yields, capital market yields, all up significantly. Look at the 2-year, added 38 basis points back on, 35, 31, 28, 23, almost a full 25 basis point rate cut right across the board, except for the 20 and the 30, but up they went, down went TLT, down went bonds as well. All the rates, except the 30-year, all the rates were lower last week than at the start of the year. Now we've got all the way out to just the 5-year. And if we look at money market rates, this strikes me as odd. You got 11 basis points creeping up on the 1 month, but no change in the 2 months, still at 4.88. Maybe pricing in the possibility that there'll be no rate cut in November. Balance sheet down quite a bit, 33 billion. The SOMA's run off 19 billion to 6.53. So the balance sheet itself in other places had a runoff of 13 billion. Wait till you see reserves. The curve threatening inversion again, only 5 basis points upward sloping. You start to get a whole bunch of good data. You get a strong read on CPI this week. If it doesn't moderate more, if it doesn't drop, even not even go sideways but tick up, you will, I think that curve will uninvert again. Will invert again, but that is a big move there. Canada has re-inverted, negative 3.4. And big movement still on the money market, the capital market curve, and of course the curve being that yields are going up. You got a bearish movement on the long end of the curve. You're going to get a little bit more curvature. Money market funds, I think I have solved this puzzle. It took a bit of thinking and some logic and hearing. I heard something on Bloomberg. I thought, wait a minute, is there something to that? So I started looking up some numbers, doing some quick calculation, and I can account for almost all of the money market funds here. Increased 38.67 billion. So when I saw that, I thought there's something going on here. This doesn't comport with what's going on in the rest of the market. 6.46 trillion. Retail up, institution up, government up on both of them. Prime up here, prime down here, sort of a trade-off on those, but sitting at 6.46 trillion, and you know my opinion about the term money on the sidelines. I've been saying it for quite some time. Whenever somebody wants the market to go higher, for years and years and years, they've trotted out that excuse. There's lots of money on the sidelines, pointing to how much money is sitting in money market funds. There's a lot of money on the sidelines, a lot of dry powder on the sidelines. This money, there isn't 6.46 trillion on the sidelines, because that would presuppose that assets under management would equal zero. That is simply not true. And on the next screen, I'll show you a chart of money market funds, even in good times, and what the balance is in good times. So it is a home to a lot of money. It is home. It's not the sidelines, it's the home. Okay, I'm inserting something between my normal transitions, but it fits with money market, the money market puzzle. Top screen, population, age 65 and above for the United States. Go back to 2010, 13% of the population was 65 or older. Population being 306 million, you had 39.88 million people 65 or older. Fast forward, you're at 17.6% of the population. Population now is 334 million, so you have about 59 million. You've gone from 40 to 59 million that are 65 or older. When you are in retirement, your portfolio no longer is in accumulation phase, it's in distribution phase. You're actually taking money out and spending it. What wealth managers typically do for the year or during the course of the year is they move money into money market securities to meet the spending needs of their clients throughout the year. So I may say, well, I need this much money over the course of the year. That money, or some portion of it, whether quarterly or semi-annually, would be moved into money market funds to meet disbursements to me, whether it be monthly, quarterly, or however. I heard one wealth manager talking because money market rates are so high right now, he's proactively moving a year to a year and a half of spending into money markets. And he says this is a strategy being followed right now. So wealth managers are moving funds to money market, whether overnight up to 1 year, to meet distribution requirements, to take advantage of high cash rates before they are gone. In some cases, proactively for the whole year, moving the whole year of spending in there. Well, how much is that? The average annual expenditure of individuals 65 to 74, and this is all based on U.S. data. For 2023, the average expenditure 65 to 74 was $65,149. 17.6% of a large population. You got 59 million people over the age of 65. The average, now this is the average, typically about the top 30% of pensioners would have wealth managers, because throughout your career you contribute to government pension plans, you may have corporate pension plans, and some people have private pension plans, and some people on retirement move their corporate pension plan to a private pension plan. They take what's called the commuted value because they can do better than what the company pension plan can do. So if you take about 30% of this population and you say, well, if they moved that money into money market funds, you get a really big number. So you got to go a little bit lower. So just with some simplifying assumptions, I get to about 1.5 trillion that would take advantage of, look, I'm going to need this money liquidated over the course of the year anyways. Money market rates are very high. They are going away. Let me take advantage of them now. I get to 1.5 trillion. Let's go down here. This is money market funds, total financial assets. And we are at 6.547 trillion. Look at through 2010 to 2018, 2019, with almost no interest rates at all, like zero interest. You made nothing in money markets. Like you made nothing. That was 3 trillion. You make nothing in money markets. There was 3 trillion. This period of time right here, this is when interest rates were going up. This is under Bernanke. He rose rates to 5.25%, and look what it did. It drew funds into money markets. And then, of course, when rates came down, it went out. Now, you could say at that time there's money on the sidelines waiting for better valuations. You know, that when interest rates come down, it'll force that money out, but only to 3 trillion. It never came back down. This is 2 trillion down here. It never came back down to 2 trillion because the money supply, if you overlay this chart with growth in money supply, here's what you get. You get the same thing. So as the money supply is increasing, the money in the money market funds is increasing, but as a percentage of the money supply, what you would get is this. That money's not on the sidelines. That money is just a flat, normal percentage of the money supply. In fact, it isn't quite like this. It's more like this. You actually have money market funds at this point in time are underinvested in, considering the size of the money supply. So 3 trillion at low rates. So given the growth in the money supply and increased rates, I say throw an extra trillion on there. That is conservative. You get to 4 trillion. The other 1.5 trillion, given the sheer size of retirements, you get to 5.5 trillion. And I haven't even hit pension funds yet. Total financial assets, 27.4 trillion. that they wouldn't move an extra 1% allocation or 2% allocation to cash. These are institutions now. So they would use the institutional money market funds, usually have a higher minimum investment, so they would move money into there. So I think when we talk about money market funds, you have to recognize there are normal assets under management, and you have to account for growth in M2, because this is what you've had over time. As the money supply is increased, the proportion of that sits in money market funds has been fairly stable. But you can't expect money market funds to be like this all the time while money supply is increasing, and anytime money market funds go up, start saying, money on the sidelines, dry powder. The only way that you can say that is if the proportion of money market funds to the money supply were going up. But it has actually got a downward slope to it. So you would conclude that there is no money on the sidelines, that you'd have to look at the equity market and the bond market and say that's money on the sidelines for the money market. It's not that the money market has money on the sidelines waiting for the other markets. It's that the other markets have too much money and the money market is saying, give us our money back. It's the other way around. Some of the money market funds is warehoused. It's just being warehoused for consumption. It is not on the sidelines. You could call it the sidelines for consumption if you want to say that's money on the sidelines, because of what I explained over here. And then, there's money in there for safety. Safety being, well, I need some liquidity, maybe a little more liquidity than I would normally need. And these are great rates, and I don't like what's going on in the world. That's not the basis for arguing for another leg up in the market to point to the 6.5 trillion on the sidelines. If you were going to be honest to the data and to history, you would say some of the money has got to come out of the equity market to go back into the money market to get to keep the ratio of money market funds to the money supply consistent, because it is underinvested right now. So spread that around, and hopefully we could put an end to this silly statement of there's a lot of cash on the sidelines. That's a lazy statement. That's somebody who has nothing left to say. Hedge funds are underperforming their benchmark. There's a lot of money on the sidelines. Almost as if they were a real estate agent in their previous life. Well, there's a lot going on this screen, right? November 7th, FOMC, 32 days away. Look what we got going on here. You have some weight on zero. 1.1% probability on zero. 98.9 is on 25, 0 on 50. That went from 54% the week before. It was basically split 50-50 almost to no, it's going to be 25 and maybe a 0. I think I closed out my my ZQ positions a little too soon. But after that 50 basis point move, it was like it knocked me out of that position. And had I not closed it, I would have been right. I'm going to learn to trust my instincts here. December, 4% off the table. That was 28% probability last week. That is gone. 4.25% being when I do this is the upper end of the range. So this would be 4 to 4.25. 50% by the end of the year, only 18% now. 4.5 being the upper end of the range. 81%, there was only 21%. And maybe only one rate cut. There is some probability on only one rate cut, but this is saying you're going to get 25 and you're going to get a 25, which I think is more likely than not, unless inflation is hot. But this is going to be a tough decision for the Fed if inflation comes in hot, because they led with 50. The fingers will start wagging. They'll be frowned at. Fingers will be pointed and saying, you guys messed up. You should have gone 25. Well, we'll see what happens. Jumping out to December of 2025, the median upper end of the overnight range was 3%, is now 3.5%, 50 basis points coming out of all of 2025. Let's see what we got going on this week. U.S. election, we may as well start watching that. 31 days. 31 days to the U.S. election, 32 days to the FOMC. India, they have a rate decision in 2 days. And if we jump down here, South Korea has a rate decision in 4 days. We saw their inflation isn't really that troubling. Mexico, we get their inflation rate in 3 days. September FOMC minutes we get in 3 days. I'm reading that. That 50 basis points. What was going on in that room to get to 50, right? US CPI in 4 days. There's your risk event this week for duration is right there. Your risk event for markets is plentiful because we still have Israel. You do have the backdrop of China stimulus. We do have bank earnings that start this week. But CPI, that's a big one. Canada Jobs Day on Friday and US PPI in 5 days. If I had to pick a day where I most absolutely got 5 days to trade, you have one where you can show up, this would be it. That's going to be critical for determining when the next step is, because the economy is not weak. The economy doesn't need rate cuts. So it has to be, it still, if you're expecting rate cuts, it must be a disinflationary story. It must continue on. It's do or die for the long end of the curve, I'll tell you that. New York Fed, effective federal funds rate, 4.83. Reverse repo down 106 billion because we are after the end of the month, end of the quarter, 436 down to 330. Down 106 billion. Reserves really dropping as well, 3.09 trillion, down 44 billion. So the combination of reverse repo and reserves, less what I think ample is, under $1 trillion now. We're under $1 trillion, but these are variable series, especially reserves. They're rather variable, but the trend has been downward. So 23.18 months. I don't think we're going to get that far. Also, I think that as rates come down, this here is probably, maybe it's even 41 or 42 now, because you will have prepayments on MBS. And they're not reinvesting any of the principal payments on their, did I say MBNS? MBS, mortgage-backed securities. You will have increased principal payments. So the cap is still in place. They didn't lower the cap on that. I would look for probably spring to hear a conversation about when they're going to stop the runoff of the balance sheet. They'll start the conversation in spring, but sometime before the end of 2025. Organically now, I think balance sheet runoff will end. And when I say organically, it means nothing external that causes the Fed to say, we need to stop this now, we need to lower the rates and flood the market with liquidity. Like, nothing external. You get Israel attacking a nuclear facility, and that is a possibility in Iran. And you get Iran hitting back at all the infrastructure in the region because they promised that. You could get that global hit that sends everything into a recession. We are close in that sense. Lots of Fed speakers this week. Monday, Bowman, Kashkari, Bostic, Musalam. I'm not sure about this name. I've never looked this person up, but I'm going to have to. Tuesday, Kugler, Collins, Jefferson. Wednesday, Logan, Barkin, Goolsby, Williams, Barkin, Jefferson, Collins, Daly. Barkin twice. And Thursday, Cook. Friday, Bowman. Lots of Fed speak this week. On top of the CPI, after a 50 basis point rate cut, on the back of really strong job numbers, what are they going to say? Real rates all moving in sympathy with nominal rates, all higher. Not as high as the nominal rates, which is dragging the break-even rates higher. So CPI will either confirm that was the right move or not enough. Either not enough or, no need to worry. Inflation is not the enemy. That's, as I said on the previous screen, that's the big risk event this week, I think. For Fed funds rate, looking at the futures curve, Q4, 57 basis points, Q1 and Q2, adding them all up, you get to a total of 154 basis points versus 178 last week. So it has some of that euphoria has come out. And I looked at ZQ for the July ZQ I closed it at a profit after the 50 basis points, I think a couple days after. Had I just held on to that one, had I just closed the October and the January and left the other ones open, I'd be very happy today. Now I'm upset because I was right in my logic, but the 50 basis point move knocked me out, and I said, well, okay, so I was wrong, but I was right. They were wrong. I was right. That's pride, isn't it? TLT didn't have a good week. Not at all, down 3.06%. SPX held on, basically just held on. Implied volatility slightly coming back in TLT. I was active on this contract, with the options. I was active there because rates are coming down. They never come down in a straight line. There's going to be a lot of thinking and rethinking along the way, but rates are coming down. So it's just not a question of if rates will come down, it's just a question of when. So it's not if I will win on TLT, it's just when I will win. 30-year fixed rate mortgage, 6.12. But this is only to the Thursday. Haven't seen Friday. Friday, it probably ran up quite a bit. Housing stocks really pulled back on Friday. But up 4 basis points. The 10-year Treasury was up 16 over the same period of time, so the spread decreased 12 to 227. But we don't have the benefit of Friday because this is as of Thursday. Nothing enjoyed this. Mortgage REITs and housing all pulled back. Housing all pulled back. The housing ETFs did, the REIT index did, but look at XLU, which is a duration play, which I do have utility exposure. I was pretty happy about that, saying, well, there's the power of diversification right there, right? So what is driving AU? Well, rates do drive XLU because it is very bond-like in its cash flows. But what's driving utilities now is the AI play. AI needs a lot of power, a lot of energy, and infrastructure, because you do have to upgrade a lot of the infrastructure, expand the infrastructure, and there's still talk about you need to convert the infrastructure to greener pastures. So that is a lot of growth in assets coming up over the next decade, let's say. And we know that utilities make their money based on the growth in their assets, the growth in what's called their rate base. The rate base is the amount of assets the utility says that they can earn a return on. The utility commission says they can earn a return on. So if we want to know how earnings are going to grow for utilities, we want to know how assets are going to grow. That is a lot of assets that have to be added. That's all we need to know. That is outweighing the counter move in rates on this one here. So you're getting, oddly enough, some growth in what is otherwise just pure value. So you got some growth component in utilities. Who'd have thunk it? Corporate OAS, corporate spreads. Again, this is Thursday, much like the mortgage rate. We don't have the benefit of Friday in here, but nothing to see. Even in Triple C, down 62 basis points to 800. The spread 800 on that one. And issuance for September, we have that data in. Nothing going on. Everything is fantastic. Look at that. Year to date, January to September 2024, over 2023, and these are at a higher risk-free component of the spread, up 33% year to date. Just looking at September over September, investment grade 133 last year, 185 in issuance this year, 22 billion for high yield, almost 38 billion on high yield here, and 1.35 billion on convertibles, which typically have very close to 0% coupon. Investment grades tend to be issued as unsecured and tend to have terms to maturity more than 10 years. High yield tends to be issued as secured with a significant amount being callable and typically less than 9 years. So high yield, if we're looking at the high yield sector here and here, usually have a spread over whether it be a 3-year, a 5-year, a 7-year, whereas investment grade, which is here and in here, usually have a spread over a 10-year, 20-year, sometimes even a 30-year. There are 30-year investment grade bonds. Being that spreads are so tight, and we did have some bullish movement on the long end of the curve last month, the yields, the all-in yields, are really not that unattractive for issuing more debt. But if we look at the credit markets here, there just doesn't seem to be concern about anything. We haven't seen anything in OAS for as long as I've been presenting it. It's like the most boring part. I get to it and I say, well, what am I going to say about this? You know, different week, same story. Let's go back down here. Look at housing, right? Big pullback here. I would love to see this pullback continue to leg back in to housing, to be able to get into housing at what I think would be a price that would be decent enough. So, fingers crossed that we get a little bit more. Mortgage apps ending the week of September 27th down 1.3%. That ends 5 weeks of mortgage applications being positive. That's the end of that streak, and now we got to start another streak. Well, let's turn our attention to China and a key indicator, copper. This is a 1-month chart of HG, which is the COMEX contract for copper. This was the stimulus announcement on Tuesday, the monetary. This was the fiscal on Thursday. You can see the jump in copper, and then from there it's sort of gone sideways. COMEX total copper stockpiles 70,848 tons. Last week 66, so inventory's been increasing. But the bigger story, look at Shanghai copper inventory, September 9th to September 26th, from 109,000 down to 53,000. Zoom out a bit more. Let's look at July 1st to September 26th. 250,000, 53.98 thousand. That's the number here, 53.98 or 54,000. That is a big drawdown in copper inventories. So in the U.S. you have an increase, you have a decrease here. Couldn't find much for the London Metals Exchange. I think you have to pay for it, but I couldn't find inventory amounts there. But it's China that's going to drive the price. So I think that copper prices and copper mining stocks will be well supported for a while, unless over the next few months you start to see a build in copper inventories. It could be that they just stop taking inventories and we're just drawing down their inventories with an amount of, let's say, underwhelming demand, but just said, no more, thank you, because the copper inventories in the U.S. really climbed. It could be that. So we'll have to wait and see. The announcements were just made 2 weeks ago. During last week, most of China was on holiday. This will be the first week coming back. I expect their stock market to continue, but it's going to be a while before we see the actual the real impact in the real economy. But I think it might be worth watching copper inventories. I think they'll be well supported here for a while. So I don't know that I would say, well, I'm going to fade this. I wouldn't be shorting copper miners, and I wouldn't be shorting copper. I may not want to be long copper, but I certainly don't want to be a short copper. The copper miners, yeah, give me some weakness on copper miners, and I will sell puts on copper miners. Okay, another event this week that is happening. Oh, also, I forgot to mention the backdrop. The big event this week is exam results for CFA Level 1 and Level 2. I don't expect it to move markets much, but it will move some people's emotions a lot. October 10th, Tesla Robotaxi event. It's an event. Gonna have to watch it. Here is their stock chart for the last week. Weakness over here, Iran threats, and then they reported deliveries, and they really took it hard on that one. They dropped significantly on news about auto deliveries for a company that apparently is not a car company. Odd that they would respond that way. It would be like GM dropping in price because hot dog sales are down. I said GM is not a hot dog company, they're a car company. But there it is. There's the reaction to not a car company delivering car results. Up 6.6 year over year, which is auto industry normal. That's not growth, that's auto industry normal. It's not 50% anymore, that's long gone. So given their valuation, I say here, this cannot be just a battery electric car company, because if it is, they are massively overvalued, even at optimistic earnings of $320 over the next 4 quarters, given a price of $250. They're trading somewhere 75 to 80 times forward earnings. So if they're just a car company, that is massively overvalued. You can give them a 10 to 15 times forward earnings for a car company, right? So there's a lot riding on this event. This is interesting here. They lost their chief information officer before the event, which is rather interesting, that if this person was going to resign, you would think that they would do it after the event, not before, but they're stepping out before the event. A couple of things to note here. There is no national autonomous only regulatory environment. All of it is geofenced. So the idea that on the 10th or on the 11th, you can send, if you're a Tesla owner, you can send your car out on Robotaxi rides is pure fantasy. There is no national allowance for that at this point. It's all geofenced, all of it. There is no allowance for privately owned vehicles in this. They're all company-owned vehicles, and they have to be company-owned vehicles because they have to self-insure. There is no insurance market for this. So there is no insurance market for robotaxis. All providers self-insure, and when you self-insure, you can't just say, oh, I got this. You actually have to set up an insurance company and self-insure. You actually have to follow the regulations on that. No individual can do that. So it doesn't even exist. October 10th, there are rumors out now and about a bunch of yellow cyber cabs driving around, kind of like a Zoox. No steering wheel, no brakes, which is not meant for level 2. Without a driver, FSD is not there. It's just simply not there. There is another rumor that they may also announce a low-cost vehicle at the same time that they're doing this. And that's October 10th. They have earnings on October 23rd, which I think this is rather interesting timing ahead of earnings. I don't anticipate these will be good. I think these will be disappointing, and this is hype. So you got the hype in front of the disappointment, and I call it hype because if it was real, if there was something here and it was real, this guy's not leaving. This guy's not leaving because those stock options are going to be worth millions and millions if this was real, right? If it was real. So just interesting on that one. Dedicated robotaxi firms must own their entire fleet. Now, this is the wedge that Tesla may have, or at least it is the wedge that they felt they had when Musk said that all existing Teslas will become robotaxis. That was the excitement, is that, well, to date, all robotaxis had to own their own fleet, and it's hugely capital intensive, to the point where the cost is about 42 cents a mile to run a dedicated robotaxi business. That is 2 to 3 times the cost of car ownership. So the idea that, well, I'll own an autonomous vehicle that will drive itself and I'll never have to drive again, you're agreeing to a more expensive solution to your inexpensive problem. That's not how technology works. Technology works the other way, is that I will pay for this because it is a cheaper solution to my expensive problem. Well, a self-driving car is an expensive solution to a cheap problem. Just drive it yourself. but 2 to 3 times as much as car ownership. Also important to keep in mind, Waymo and Cruise lose money. Waymo's doing about 100,000 paid rides a week. They use Jaguar, I think it's the F-type vehicle, and then they augment it with about $40,000 worth of hardware to get it to do what it does. It still has a steering wheel and a pedal. It's not a purpose-built vehicle like a Zoox would be. And even at 100,000 rides a week, they still lose money. So it is a lot of money that has to go in this. Estimate is some extravagant estimates, I think. Whenever I hear about the total addressable market, I say, ugh, give me a break. But that by 2030, right, in just 6 short years, this could be in the US a $1.3 trillion market. But other estimates are like, yeah, at a $1.5 trillion cost, you'll have 1.3, you can create a $1.3 trillion market. So it's going to lose money for a long time. If they're going to introduce, which based on the rumor here, a box, with seats inside where people can sit, and it has, its wheels and no driver, no steering wheel, no pedals, kind of like a Zoox. If they introduce something like this, what about that promise they made to all the Tesla owners that their vehicles will earn $30,000 a year driving themselves? That's kind of out the window on that one. But if they introduce something saying, no, we're going to bypass all this, we have a way such that that whole fleet can start driving, all the Teslas that were sold can start driving, we don't have to own our entire fleet, and we will insure them. They may be able to do something like that. Problem there is the software, the hardware that is required for that software doesn't exist on the vast majority of the vehicles that they have sold. So everybody with a Tesla in their driveway saying, oh my God, I'm going to make 30 grand a year. Nah, probably not. Probably not. Based on what the reports of these cyber cabs, it's looking more like it's going to be something like this, where Tesla is the owner of the Robotaxi, and there is no crowdsourced Robotaxi fleet at all, which is going to upset a lot of Tesla customers. Now, here is one narrow little window where I do see they may have an advantage. In an interview with the Zoox guy, he said, look, this is not cheap to do. You have this purpose-built vehicle, and then you got to collect millions and millions and millions of miles to get this thing, to feed it the software. Well, what did Tesla do? It promised all these people who bought Teslas that you will have a Robotaxi one day. Back all the way to 2019, he was saying your cars will be earning money. Drive them, drive them. And it took all of this data and it fed it into its algorithm. And then it takes all of that and says, aha, we're just going to do it ourselves. Thank you for the data, though. Thank you for all that data. And for some of you who paid for FSD, thank you very much for helping us fund this. But we're going to go our own way. That's not going to go over well with the Tesla car owners. It's going to be an interesting show. The narrow window Tesla has to land this plane is to say, we've got this, we're going to do this, and everybody's car will be able to operate on the software. It's just around the corner, right? It'll be, if he pulls out the just around the corner and tries to keep the hype going, comes down to this. The stock price will depend on the willingness of the shareholder to believe in what otherwise can't or won't be done. And that's what it comes down to. I have no doubt this can't be done. I'm pretty certain this can't be done, not the way that he's promised. Can Tesla create a Robotaxi like a Cruise or a Waymo or a Zoox? Sure. But all those cars are not going to, all those privately owned cars are not going to be Robotaxis at all. In fact, I will state this right now. If only one privately owned Tesla takes a Robotaxi fare for even 1 mile for $1. If a single privately owned Tesla leaves their parking lot, that means the car has to leave the parking lot, pick someone up, drop them off, and come back. Even one, I will buy a Tesla. I will go out and I will say, okay, I'll be a Tesla owner. I will buy a Tesla car. If by the end of 2025, because you got to put a time limit on it, we'll give him a whole year, because apparently it's just around the corner. In his last interview, he said he'd be surprised if it wasn't the end of this year or mid next year. He'd be surprised. Well, okay, if it happens, I will buy a Tesla. Here's my prediction. I won't be a Tesla owner. I am short. I'm short shares. Not many, because it is a stupid stock to short shares with. I'll tell you that. You got to be tactical, trade in and out, which I do. And I am long puts at a 220 strike for December. With being long puts, you agree to lose a certain sum of money, and that's it. So I can't lose more than that. If there's weakness before the event where it gives me an opportunity to cover my short shares at a profit, maybe I'll do that. Maybe I'll do it, and I'll just, I won't get greedy. I'll stick with my puts. If not, well, we'll see. This is going to be pure hype. So I am expecting that the Teslites will just believe that it's just around the corner, no matter what the reality is. I think they'll believe the hype. And then you have earnings on the 23rd, which there's reality. So you have a fantasy event, and then you have reality. Okay, the yen versus the peso. I think the carry trade is still in play. Japan really can't raise rates. Ishida had mentioned that he is in favor. He supports the BOJ's desire to raise rates. He said last week over here, this is where he said it, the economy is not ready for further rate hikes. They can't raise rates. They can't. I said that. Their debt to their GDP is far too big. Here's what happened. And then, of course, the jobs report, you had a stronger dollar. There you go. We're back at 140, 148. Down here was 145. This is Monday. Strong U.S. dollar on Powell comments that the Fed is willing to take its time in lowering rates. So the U.S. dollar gained some strength, and then the yen went sideways, and then we're not going to do it. We're not going to do it, and then another strong dollar. Look what happened to the peso over that period of time. When you had a strengthening yen, you had a weakening peso. The peso was all the way, I think it printed a 16 handle at one point. And then it just ran all the way to 20, slightly a little overhead of 20 with the yen the carry trade, the unwinding of the carry trade. The peso was the most likely target because of the interest rate differential, and it still is a very large interest rate differential. And even though you had U.S. dollar strength on Friday, you had a peso that was fighting that and actually gaining strength into it. Gave back a little during the day, but certainly was showing resilience as the yen was weakening. The peso was strengthening. So I think that is back in play. I think it will continue. We're got a 19 handle on the peso right now. As I said earlier in this video, it wouldn't surprise me to see an 18 handle by the end of the week, especially if you have a weak CPI and the U.S. dollar weakens. That would add even more strength to the peso. I came across these two really interesting charts, and I think they do a lot to make my point that Japan cannot raise rates and the U.S. is going to need lower rates. This first one here, each circle represents the size of a country's public debt, and inside the bubble we see their debt to GDP ratio. There is Japan, 252%, the second largest, because you got Sudan. I don't even know if you can count Sudan, but there it is. So we can say they, other than Sudan, they are the largest in debt to GDP by quite a bit. The next closest one is Greece at 169%. They're 252%. US 122%, but has the largest debt out there. There's Russia way down there. There's Israel over here, Germany, Brazil, India, all over 100, under 100%. I draw the line here to show where they sit. China at 84. Anything below the line, they can handle higher rates. So their monetary policy does have some power in that if inflation shows up, they can raise rates to crush inflation. They can focus on that without hurting the economy too much because it's not going to hurt the debt burden and the coverage or the service burden. U.S. at 122%. Over 100%, higher rates really will make the debt worse. It won't make the debt worse if, with higher interest rates, you squeeze out other government spending and balance your budget. You'll be okay. But that's not what happens. Is higher interest costs just make the deficit wider, and the deficit adds to the debt, which makes the debt worse. So it can only make the debt worse. When you get to the level of Japan, you simply cannot handle higher rates. Let's go to the next screen here. This is debt interest payments per capita. U.S. is number one. We're number one. Yes, they are. When you hear the chant, you could say, "Oh yes, I do. I know one thing you're number one at is debt interest payments per capita. No one is higher, 2,464, which means if you don't want to add the interest expense to the deficit, you must extract $2,500 from every single person in the U.S. Babies all the way up to the infirm in the hospital. Every head must pay $2,500. So if you're a family of four, 10 grand a year, please, extra above what you're paying, and this won't add to the debt. That simply can't be done. U.S. has high debt, as we've seen over here. Look at the size of the bubble. No one's bigger. And high interest rates right now, which gives you this result. If you had high debt with low interest rates, you can get this bubble down. And if you get this bubble down with low rates, you get the servicing component done, which means this bubble's not going to rise as fast as it would normally rise. But with high debt and high rates, this bubble will rise. This bubble will rise even faster, which will cause this bubble to rise, which will cause this bubble to rise, which will cause this bubble to rise. See where I'm going with that? You have to get interest rates down. We know the debt is not going down. Interest costs must come down. I don't think the central bank in the U.S. has any choice but to go to the zero line. I think this is what you're going to see in most advanced economies is look at Japan. Japan is in a trap. It cannot raise rates. If it raises rates, it crushes its economy with interest costs just because of the sheer size of the debt to GDP. You're not going to grow your way out of a 252% debt to GDP ratio. You're not going to grow your way out of that. There is no solution other than make it free. There is no solution. Make it free and inflate it away is all you can do. And I think that is the inevitable conclusion in advanced economies where democracies have turned to popularity contests and not elections anymore. And with popularity contests, it's about who can give away the most money. Look at Harris and look at Trump and everything they're promising. No tax on tips, no tax on this. You get this and you get this. And here's $25,000 for your house. Or here's $50,000 for your start. You see where I'm going with that? No choice but to go to the zero line. The Fed believes that they are independent and they have a choice, but they do not. They have a very tight constraint. And they can be variable within the closing walls that they're in, but those walls are closing on them, and they will be the BOJ. Mexico's down here, 795. Low debt, but high rates, and right now, big deficits. But their rates are coming down. I don't see their debt servicing as being much of a problem. Here's Canada at 270. Debt servicing, not much of a problem here. Japan, well, you have low interest rates, right? $41 per capita. They have a fairly large population and very low interest rates. You have a bubble up here, you got to put the other bubble down here. You got a bubble growing here. You look at this, you got to get this thing down. And this one here, you got to keep it down if your bubble is up. If your bubble is going up here, your bubble here has to be going down or you're going to crush the economy. There's nothing wrong with owing $10 billion if it's 0% interest, right? Nothing wrong with that. But there is a lot wrong with owing $1 million at 15% interest, because that problem's just going to get worse every single month. So you got to get that down. Look at some of these down here. Norway negative, Kuwait negative, because they have a sovereign wealth fund that actually produces income at a greater amount than their debt costs. And with South Korea, same thing with South Korea. China is really low. India is really low. So in terms of, competing, when you think about where India, Brazil, China are in terms of the debt capacity that they can take on, and in terms of the cost that they currently pay, they're in a far better position than the US. If these were companies and you were looking at their ability to fund CapEx over the next 10 years, you'd be shorting the US and going long China, India, and Brazil, just on debt capacity for infrastructure investments over the next 10 years, right? So this is my argument. This is a big part of my argument of why eventually the Fed is going to be constrained to going back to the zero line, and why their balance sheet in 10 years is going to be double what it is right now. If you want to see where the Fed is going, I think it's going to where Japan is going, unless it does something and says, hey, we got to get this bubble below the 100. We got to get that bubble down to pull this bubble down. We can't get in, because right now this bubble's going up, and only interest rates will get this bubble down. You want to get this bubble down, you got to get this bubble down. I don't see it. And I think Canada's bubble here is probably going to start to increase as well. So it'll be a question of, well, what are they going to do with their bubble on this side? Bubble-omics. Yeah, let's call this bubble-omics. Okay, I think we do have to pay attention to geopolitics at this point. Israel is contemplating what its retaliation is going to be. October 7th is the 1-year anniversary of the Hamas attack, and that is tomorrow. The IDF, this is the Israeli military, has said we're looking at significant and serious retaliation. Netanyahu is saying the same thing, and his popularity is on the rise in Israel. So he's getting more and more popular support, even though the world is sort of against him. Macron has come out and said that he does not support arms to Israel at this point in time, that has to end. Let's look at their retaliation. And I did a lot of research to get this done. I didn't want to just talk off the top of my head. So most of these points that I've got down here are analysts, and I've listened to a bunch of different discussion panels and read a bit from all. I think one of the ones I read was an Israeli paper, Jerusalem Times or something. Anyways, the choices are military, economic, or nuclear. Let's start with nuclear, because that is the worst. Biden is against this one. Most likely Harris will be against this one, but Trump, nope. Trump would support this one. In fact, Trump has come out and said it would be crazy not to hit them. So if you were Netanyahu, you were thinking, well, this is a way we can just take out the permanent threat of Iran getting a nuclear weapon and using it against us. We can take it out. Who's going to win the election, right? If it looks like Harris is going to win the election, well, you need relations with the U.S. If we do something like this, it may be difficult to keep those relations, and you can't do it without U.S. help because they're underground below several dozen meters of rock, and only the U.S. has a certain type of weapon that can actually penetrate that and get that done. So you need the U.S. on board. With Biden or Harris, they're not on board. With Trump, he would be on board. You have a November 6th election. That's 1 month away. It's 4 weeks away, basically, 5 weeks away. He may be willing, Netanyahu may be willing to hit a lesser target, but if Trump wins, this is on the table. This is on the table. So just even if this is not part of the retaliation, my thinking is it's on the table. but it's not likely without U.S. help. Naftali Bennett, the former prime minister, we must act now to destroy Iran's nuclear program and central energy facilities. There is a lot of support for getting this done on that side, and with Trump, Biden and Harris, not really. Now, I don't know how much of that is related to the upcoming election. Right now, Harris does have, probability-wise, a chance of winning this. It's looking more and more likely from almost a guaranteed Trump win with Biden to, a dead heat to maybe even a slight advantage for Harris. So they don't want anything happening geopolitically that could ruin that, but maybe after the election and they win, maybe Harris would say, okay, you know what? Yeah, Iran is a problem. Let's take them out. Maybe. Let's go to military. Missile and drone bases. These are deep under mountains. Again, you need U.S. support for this, and the U.S. would support this. Air defense bases also be beyond missile and drone bases. You get air defense bases on a larger scale than they did in April, or the military industrial setup in Iran take out production of military output. Economic, Biden is not in favor of this. He's against this. He's not in favor of this. He's in favor of this proportionate response, as it's called. Here it's oil infrastructure. This is looking like it's the most likely response, but what do? Do you hit the export terminal or do you hit the refineries? There's the Carg oil terminal. 90% of exports go through this terminal, most of it to China. You would cut off the flow of money to Iran. There is the Abadan refinery, which produces a significant amount of Iran's domestic needs. You would bring Iran to a halt. For mobility purposes, you'd bring them to a halt. So you can either do that, but they'd still have the flow of money coming into the country to fix the refinery, or you could take out the refinery, stop the flow of money coming into the country altogether. Iran has stated they would respond to this with a more wide-ranging missile barrage. All infrastructure of the regime will be targeted. Now, when they say of the regime, I'm not sure if they mean just Israel or infrastructure everywhere would be targeted. That if their oil exporting facilities are down, everybody's are going to be down, and the world will pay, right? Because that would send the world into a deep recession if you took a whole bunch of export ability out of that region. So this is a big one. This is a big move, and he's not in favor of this before the election. November 7th, I am sure they'd be in favor of this. November 6th, up to November 6th, let's be proportional. Let's not do anything that would ruin the potential chances of a Democratic victory. After the win, something's going to happen, because after the win, I think both the Democrats and the Republicans would be more willing to do anything. We know the Republicans are willing. If Trump wins, you're probably taking out these targets. I'm sure he would be 100% behind that. He's said it would be crazy not to, and he's itching to be a wartime president. This still is a possibility here. So that the markets around the world seem to be so complacent about this. We are a smidgen away in the U.S. from all-time highs. You get an economic or a nuclear target that is hit, those all-time highs go away significantly. The window of opportunity here is a proportionate military strike to demonstrate to Iran that Israel would say, look, we can hit anything we want, whenever we want, and we'll show you. We're going to hit these three things, and there's nothing you can do about it. Just to demonstrate that you don't mess with me. I don't think Israel wants to do that. I think they're in a position now where they're saying they can take out all their enemies. They have momentum. Let's do it. Here's a map of Iran and showing you just location-wise where everything is. In red over here along the coast, those are the oil terminals. In black, these black circles, these are the oil refineries. This is the one that they would think about taking out, is this refinery here. The ones in blue, these are missile deployment sites, and where inside this pink area are all the nuclear facilities. So as you go from the oil terminals to the refineries, to the missile sites, to the facilities, you have to go deeper into the country, and these facilities are deep underground. Missiles landing on the surface aren't going to do anything. You have to bust the surface, and only the U.S. has a particular type of missile that can actually get it done. You need the U.S.'s help, and Biden is saying, nope, I'm not doing that. So it's probably off the table unless Trump wins. Either way, there's going to be some kind of response. It's either going to be the military or the economic response, but I would not remove this. I would not remove that going forward. And why, world markets and aren't a little bit more concerned about that. Why that is doesn't have a higher probability, I don't know, especially when you have a candidate who could win, who is saying things like it would be crazy not to do it. Anyways, you have that to look forward to this week. Even while I'm doing this video, some things might be going on. I don't know. But maybe we don't get to Monday morning opening without something significant happening, and futures on Monday might be deeply red or deeply green, depending on what they hit. They go military, that's not a big deal. That's all contained in one area, and one kid slaps another kid and we say, well, he deserved it, and that's it. They go economic, it has more spillover. Okay, here we are at the end. Last screen, SPY, all-time high, 573.24. That was hit on Monday, September 30th. Friday's closing is 0.16 below the all-time high, with a pending Israeli retaliation that we've just discussed on the previous screen. The market just sitting below all-time highs. We've rolled over one quarter. Our forward quarters are now Q4 of 24 and the first 3 quarters of 25. So there are the estimates. Here is the closing SPX, gives us a 21.63 times forward earnings. We rolled up about $10 each on the estimates because quarters do this, right? So this one fell off and this one came on. 21 have reported. 21 of the S&P 500 companies have reported to date. Surprise factor by 0.1. Going from the beginning of the year, Q1, the surprise factor was 8 point something. Q2 was 4.9. Not only 21, but 0.1. The 50-day moving average, 553, is 3.37% below. That's it right there. And the 200-day moving average is at 524, which is 8.59% below, which is down here. Implied volatility coming back in, 61 percentile on the 13-week versus 48. And for earnings this week, disagreement again. Let's just cross this one off here. LSEG and Sector Spider both had 9. I thought, yay, but they disagree on the components. They all agree on Friday, so okay, there's a celebration. We can at least throw them a party for getting Friday. You got 5 right, both of you. Very good. Here's a gold star. Well, maybe a silver star, right? But they get a red star up here on Tuesday. LSEG has PepsiCo and Pentair. Sector Spider says Pentair. There's no Pentair. Thursday, there's Progressive, but LSEG says Progressive. Never heard of them. Here's a good one to watch, Delta, right? And you have Domino's. Friday, JP Morgan, Wells Fargo, BlackRock, Fastenal, and Bank of New York Mellon. JP Morgan, Wells Fargo, big ones here to watch. Tuesday, PepsiCo, Delta. Why are we concerned about Delta? Who cares about airlines? Remember that CrowdStrike problem that shut down a lot of companies? Delta claims that they lost about $1 billion, something like that, like $1 billion from that. That's what it cost them worldwide. And they're looking to CrowdStrike to get that back. So if you are looking at CrowdStrike, saying, well, cybersecurity, that's a big thing. I heard a lot about CrowdStrike. Would be worth listening to the Delta call, because on that call, I'm sure they're going to talk about that outage and what their plans are. And probably going to either be some settlement from CrowdStrike or litigation, right? But it's not over for CrowdStrike. It's not over by a country mile. There are businesses that lost money on that. They're going to want that money back. So if you're interested in that one, there's Delta. So you do have some risk event going into the end of the week. Friday, you have the beginning of bank earnings, and along with guidance, we have CPI during the week. If you're a CFA candidate, whether level 1 or level 2, results are out this week. Level 3, you'll have to wait. We have the Israeli response that we're sitting around waiting to see if it's or if it's oh boy. And then the circus on the 10th, the Tesla Robotaxi day. There's your week.